Do you treat your company bank account like your personal ATM? Need groceries? Swipe the company card. Going out for dinner? Swipe the company card. Need cash for a vacation? Just withdraw it from the business current account. If this sounds like you, stop right now. You are not just breaking the tax laws, you are actively digging a grave for your business compliance. In the eyes of the law, that money is not yours, even if you own 100% of the company. But don't worry, there are perfectly legal, tax-efficient ways to move that money from your company's pocket to your personal pocket without inviting a notice from the income tax department. Before we dive in, if you need help structuring your director's salary or tax planning for your private limited company, you can contact us to purchase our professional and consultation services. The links are given in the description. Hello and welcome to Business and Tax. I'm your host, CA Kashif. Today, we are going to fix the biggest mistake founders make, treating company money as their own. We will decode how to withdraw cash using salary, dividends, and reimbursements. The golden rule: separate legal entity. First, let's get the basics right. Whether you run a private limited company or an LLP, the law treats your business as a separate legal entity. Think of your company as a separate person. If you take money from this person without a valid reason, it is technically considered a loan or misappropriation. You cannot just take the profit, you have to extract it legally. Let's look at the 3 best ways to do this. Here's remuneration, or salary. The most standard way to take money out is simply by paying yourself a salary. Yes, you can be an employee of your own company. Why is this good? For the company, your salary is a legitimate business expense. This means if your company makes a profit of 20 lakhs and you take a salary of 10 lakhs, the company only pays tax on the remaining 10 lakhs. It reduces the company's corporate tax liability. What is the process? You need to execute an employment agreement between you and the company. The company will treat you like any other employee. It will deduct TDS under Section 192 if your salary exceeds the taxable limit. You will receive Form 16 at the end of the year, and you can file your personal ITR showing this as salary income. Pro tip: since the company saves a flat 25% or 30% corporate tax on this amount, and you might fall into a lower tax slab personally, this is often the most tax-efficient method for amounts up to 15 to 20 lakhs. Method 2. Reimbursement of expenses. This is my favorite method because, if done correctly, it is completely tax-free. As a business owner, you likely spend money from your personal pocket for business work. Did you fill up petrol for a client meeting? Did you pay for a business dinner? Did you buy internet data for work? Did you pay for a flight ticket using your personal credit card? If you did, the company owes you that money back. How does it work? You submit the original bills to the company. The company books these as business expenses, which reduces its profit and tax, and then transfers the exact amount to your personal bank account. The tax benefit? For you, this reimbursement is not income. It is just the company paying back what it borrowed from you. So, you pay 0 tax on this money. The warning: do not abuse this. You cannot claim your family vacation or your personal grocery bills as business reimbursements. If the tax officer asks, you must prove that the expense was wholly and exclusively for business purposes. Method 3. Dividends. Now, what if you have taken a decent salary, claimed all reimbursements, but the company still has a huge profit sitting in the bank? You use dividends. On the profit first. Then, from the remaining post-tax profit, it declares a dividend. The tax trap? In the past, we had dividend distribution tax. Now, that is gone. But today, dividends are taxed in your hands at your personal slab rate. So, if you're already in the 30% tax slab, receiving 10 lakhs as dividend means you will pay 30% tax on it personally. Plus, the company has already paid 25% tax on that money before giving it to you. This is why we call it double taxation. Use dividends only when you have exhausted other options or if you want to reward shareholders who are not working directors. Bonus method: rent and interest. Here are two quick ways to withdraw cash legally. 1. Rent. If your office is actually a property that you own personally, like your home office or a shop in your name, the company can pay you rent. This rent is an expense for the company. For you, it is income from house property, which allows a 30% standard deduction. That means you only pay tax on 70% of the rent received. The interest on loan? If you have given a personal loan to your company to start the business, the company can pay you interest on that loan. The interest rate should be reasonable, close to market bank rates. This interest is tax-deductible for the company and taxable for you, but it's a valid way to move cash. Conclusion. So, to summarize your action plan, stop swiping the company card for personal expenses. Set up a monthly salary for yourself and deduct TDS. File reimbursement claims for every genuine business expense you pay personally. Charge the company rent or interest if applicable. Declare dividends only for the remaining profits. By following this hierarchy, you stay 100% legal and pay the lowest possible combined tax. If you're confused about how to structure your specific salary or need a consultation on your business taxes, remember, you can contact us to purchase our professional and consultation services. The links are given in the description. Hello, I'm CA Kashif, signing off. See you in the next video.